Hello, and welcome to this episode of Nucleus Wealth Empower, where I go looking for what the good life is and how finance can support and empower us in achieving that. So, following on from our last episode about buying your first home, we're going to today look at one particular aspect of that a little bit deeper. It's going to be mortgage insurance. Our guest today, Martin North, has done some research into lenders' mortgage insurance and found that in the last 24 months to March this year, the number of new loans written with lenders' mortgage insurance has almost doubled. So, we're going to have a chat today about that and what this means for you as an individual. As always, though, before I jump into the show, I'd like to start in the spirit of reconciliation and acknowledge the traditional custodians of country throughout Australia and their connections to the land, sea, and community. I pay my respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. So, on to a brief introduction of Martin. So, Martin North is the founder of boutique research firm Digital Finance Analytics. Digital Finance Analytics combines primary consumer research, industry modeling, economic analysis, and segmentation analytics to offer insight into the dynamics of the Australian property market, and is also the host of the popular Walk the World channel on YouTube. Martin, welcome to the show.
Great to be with you. Thanks for the opportunity.
Thank you. Okay, so just a quick couple of admin things before we jump into it. Please remember that we're giving general advice today, so we're not necessarily considering anything that might relate to your personal circumstances, but we hope that you might take something away that you can use. And if you would like to discuss anything, you can also get in touch with us at Nucleus Wealth on 1300 623 863 or contact at Nucleus Wealth. And if you haven't already, subscribe and click the notification bell to be notified when we go live or have a new webinar to watch. Or follow us on your preferred podcast platform and give us a like if you'd be so inclined to help our show grow. Okay, so Martin, I thought maybe the best place for us to start would be with an explanation. So what is lenders' mortgage insurance?
Yeah, and it's worth going back in history because originally when this product was developed some years ago, it was actually called loan mortgage insurance. But people got really confused, and so they changed it to lenders mortgage insurance. And the reason that that's important is because this is a particular type of insurance that's sold alongside a mortgage. And if you are looking to get a loan, let's say above 80%, a loan to value ratio, essentially you will need lenders mortgage insurance. And what lenders mortgage insurance does is to protect the lender should you default, between 80 and 100% of the value of the loan. Now, what that means is that you may be able to get a loan bigger than you might otherwise have got from the mortgage provider, be it a bank or one of the other providers. But just to be clear, lenders mortgage insurance protects the bank, not you. So in other words, if you were in the situation where that particular mortgage for some reason got into difficulty and you found that you essentially were in default, the lender mortgage insurer, which is a separate insurance company, will actually pay the bank the difference, but then they reserve the right to come after you, the borrower. So it gives you no protection at all. It simply protects the bank, makes the bank probably more willing to lend. And some would say that it actually has been one of the reasons why we've got home prices relative to income so high in Australia at the moment.
Right. So I think just maybe to clarify one of the things I heard you say there, which is that if you need to borrow more than 80% of the property, so if you don't have that 20% deposit, then that's when you might start to be requested by the bank. Is that right?
Well,
to get
pretty
lenders mortgage
much. The
insurance?
industry practice is that anything above 80% will need lenders mortgage insurance, unless you are in a particular profession. So, for example, doctors, you may be able to go higher without needing lenders mortgage insurance. And in fact, currently there's a little bit of sort of muddiness there as to precisely under what circumstances the bank will ask you to take lender's mortgage insurance. But typically, if they're at all worried about your status, if you are a pretty meat and potato type borrower, you probably will need it. And I'd also make the point that the provider of lender's mortgage insurance is complicated now because there are two external providers that provide it, QBE and Genworth, but there are also captive lender mortgage providers inside some of the banks. And so sometimes the banks will actually internally provide you with insurance and charge you a fee, right? So, but the point is, whichever route you go, you have to pay a premium, and that premium varies. It varies by the size of the loan, it varies by the risk profile, and how much above the 80% you are. So, if you basically are borrowing 95%, there's a higher risk than 80% in terms of the premium. So, but typically it can be $20,000, $30,000, $40,000, $50,000. And quite often that's then capitalized back into the mortgage. So effectively you add it to the mortgage that you're drawing down from the bank, which means you're then paying interest on it over the 30, 35, 40 years, whatever the term of the mortgage is. The last point to make is that premium, which is a one-off payment, is almost always not refundable. So when you come to move, unless you specifically ask the lender's mortgage insurer about it, it'll just disappear. So if you're thinking of moving in 2 or 3 years' time, then that is a significant chunk of additional cost that you suddenly find that you're bearing. And these days, with mortgages so big, because prices are so high, it can be quite a large amount of money involved.
Wow. That's huge. I didn't realize that that there was even the possibility of getting that refund if you were to sell the house.
Most people don't. Most people just assume it's sunk cost.
Hmm.
What I would say is if you are in the situation where you are thinking of moving, it's worth finding out what the situation is. Now, it's quite complicated because normally the lender's mortgage insurance part of the contract is a subclause in the mortgage contract, right? It's not necessarily a completely separate agreement. And you probably won't get hold of, unless you ask for it, the master policy that relates to this particular part of the agreement. So again, quite often what I find when I speak to people who've got lender's mortgage insurance is, one, they have no idea that it protects the lender, not themselves. Two, they don't know the terms and conditions of that particular product that they're being sold. And three, they have no idea that they might be able to actually get some benefit back from it if you actually then move subsequent. So it's a really one of those things where it's really more complicated than it looks. And frankly, in my experience, a lot of mortgage brokers who sell these types of mortgages with LMI, or indeed the banks themselves, are very, very bad at telling you the full story, because of course what they're trying to do is to get you to take that bigger mortgage. And of course, if you're thinking about getting a property these days, you need a big mortgage. So there's a sort of a win-win there. But the point is, you must read the small print. You must have a look at the detail here, because it can be quite expensive and there are some risks attached to it.
So one of the reasons I really wanted to do the show today was because I looked at this research and I just couldn't believe how many people didn't understand what lender's mortgage insurance was. Like, it's really alarming. It's a lot of money, and for people to not know even what it is and what it's doing for them, that scared me. So do you want to talk to the stats around that a little bit, Martin?
Yeah, so we run household surveys all the time, and we ask specifically some questions about lenders' mortgage insurance. And it's a horrible figure, right? But in round terms, about 40% of people have no idea really what this is all about at all, right? And a lot of people also believe it just protects themselves rather than the lender. That's the fundamental point, right? So in fact, there are more people who have no idea or only partial idea about what lender's mortgage insurance actually is. The minority of those who take it actually understand what its purpose really is. And that's a real big concern. And the problem I've got is that that's been the same for the last 10 years. So there's been no improvement in overall understanding amongst prospective borrowers with regard to lenders' mortgage insurers and what its purpose is. And I think, frankly, the industry is partly to blame there. But it's a big deal, right? Because if you go into it assuming that if you get into trouble, the insurer is going to help you repay the bank, forget it. That's not the case. And if you are just confused about what its purpose is in the first place, then you haven't done probably sufficient due diligence as part of your loan application process to make sure you understand. You need to understand the small print. You need to understand what's going on here. And unfortunately, many people don't.
It is hard though, like to defend these people. They're incredibly complex contracts,
Yep.
and you really need someone who's on your side, which is a lot of the reason I wanted to do the last podcast we did about buying your first home, because I just remember when I went into mine how little I knew. I was lucky enough that I had a great broker that explained lender's mortgage insurance to me and some ways that we could get around that. But there's a lot of stuff. I made sure I read the contract and that, but it's really sort of you can. It's not hard to end up in the deep end when you try to get into this stuff.
No, that's the problem. So, reading the contract is not very helpful. What you need is the lawyer or whoever is working with you with regard to make sure that they help you understand it, because it is not straightforward. It's written in legalese, and in fact, I was talking to somebody the other day whose mortgage contract was for the lender's mortgage insurance part was longer than the rest of the mortgage put together. It's ridiculous.
Oh. So did this come up in the Royal Commission into Banking at all?
It's been in a few different discussions. It was peripherally addressed in the Royal Banking Commission. The Productivity Commission looked at this relatively recently, and in fact, there were quite a few
Okay.
discussions with some of the CEOs of the banks. ANZ, in particular, has been very outspoken about the inefficiencies and inequalities that lenders' mortgage insurance actually represents. They now have an alternative themselves. CBA also has an internal alternative for some types of borrowers. What they tend to do is to chuck the most risky ones across the fence to the lenders' mortgage insurers. Westpac's just sold their captive insurer. So this is a market in a lot of movement at the moment. But the regulators have been very light touch on this. The other thing that's happened is that most recently, APRA has changed the rules, APRA being the regulator of the banks, and has basically given capital leeway to banks who actually have lenders' mortgage insurers loans. So there's actually a reason why perhaps banks will are offering these more. The point to make is, of course, the government offered these first home loan grants for people. The gap between 80 and 95, so as they underwrote them. Now that's an alternative to lenders' mortgage insurance. So of course, what happened there was that the fortunate people who got those government-backed loans were able to avoid lenders' mortgage insurance. The other thing that's going on is a lot of people, rather than going to the lender's mortgage insurer and having to pay that very big premium, might go and talk to the bank of mum and dad and say to their parents, can you give me the difference between, what I've got and what I need to be able to get my loan to value ratio below 80%, because then you can get, one, a better rate on your mortgage, and two, you don't have to pay the premium. So there are alternatives that people should consider, right, before they go into this. And the fact is, it's worth taking the time to understand it and understand what it is and what it isn't.
Okay. And so if people are interested in these, they're government loans, right? They're not grants, or are there
No,
both available?
so, so, I mean, there are first-time buyer grants. That's a separate thing. So that's just a cash payment. But this is a particular scheme where up to a certain number of loans each year are made available, um, and the government basically covers the gap between 80 and say 95 or whatever it is.
Okay.
Right? There are some different variations there. So there are some set rules, because basically it has to be under a certain capital amount, and it has to be for residential purposes, not investment purposes, and other things like that. And the amount you can get varies based on where you are geographically speaking. So, but it's all another incentive program to try and drag more first-time buyers kicking and screaming into the market, right? So, they be honest with you, the last couple of years, it's the first-time buyers who've really been propping the market up. There's been a very significant rise in the number of first-time buyers, which is why lenders' mortgage insurance counts have gone so high. And what we've seen is that by hook or by crook, first-time buyers are being cajoled into the market, of course, when prices are as high as they've ever been. And interestingly, if you put the grants together and all of the other government incentives, what you discover is that property in this sector of the market has actually gone up by precisely the amount of the government grants and the government incentive program. So it's a zero-sum game anyway.
Wow, that's huge. Do you have a view on how this might don't know, flow from here in terms of is there an unwind and
So
how that might look?
yeah, so there's a couple of things to say. So the first thing is, if you think from a risk perspective, right, you've got all these high risk loans sitting with just two insurers, right? Now they
Hmm.
are managed as separate standalone organizations with their own capital buffers and everything else. APRA supervises them. Of course, if things started to go terribly wrong and we had a lot of falls in house prices and people started defaulting, the first point of failure would be those mortgage insurers themselves.
Hmm.
And in fact, in the US, around the global financial crisis and the 2 or 3 years afterwards, when there were significant falls in prices, one of the casualties there were lenders' mortgage insurers, because it was actually a thing that was done in the US as well. So that's the first point. The second point is, like I said, if you're actually going through a default cycle and you end up essentially having to sell the property and there's a gap in the value that you've actually been able to create from selling compared with the loan, um, the bank will get paid out by the insurer, but the insurer holds the right to still come after you. So we are still on full recourse lending in Australia. So you can't just hand the keys over and say cheers, like in some states in the US, right? So you've got this debt noose around your neck until you've actually either gone bankrupt or until you've paid it off. And we do know of some lenders, mortgage insurers, who do chase down to the last dollar, frankly, what's owed. So again, in a difficult situation, that's a point to make yourself aware of. The third point is, when you're actually thinking about buying, and if you're a first-time buyer, prices are very high at the moment, and of course, the market is still spruiking. Prices will continue to rise, but in fact, it's much more complicated than that. So we know, for example, that apartment prices are actually still going backwards. We know that some home and land packages are now going backwards from where they were previously. And worryingly, a lot of those first-time buyers who contracted into first-time buyer land through home and land packages over the last 12 months or so are now contracted into a property whose price is now on the move again, because the construction costs and the availability of traders and builders has just gone out the window. You just can't get the parts, you can't get the workers. So now the costs of those properties are significantly higher. And many of those building contracts actually had escalator cost clauses in them, which means that whilst you might have thought you had a fixed price agreement for the homeland package, there is a cost exclusion. So suddenly you might need to borrow more than you thought, which then might put pressure on your mortgage lender, which means that you might actually end up having to borrow more than you thought, which means you might need lender's mortgage insurance if you didn't think you needed it in the first place. So
Mm.
there's a whole bunch of complicated things here that people need to get their head around.
Wow. Yes, it's a lot. Um, All right. So, I don't know if maybe we could just pause and recap some of the key takeaways for
Mm.
people to be conscious of around this, and then maybe after that we can talk about if you're already in one, what are some of the things you can do? I mean, I'm not sure how much we'll have to add to that, but let's see how we go. So, okay. Um, Lender's mortgage insurance. It's there if you generally need to borrow more than 80% of the value of the property from the bank. Um, it's insuring the bank against if you default and they need to repossess the house and sell it, if they make a loss on that. So it's not doing anything for you as the individual buyer, except helping you to get the mortgage, the larger mortgage. And if the bank does have to repossess the property, then you could still be on the hook for anything that the mortgage or the insurer has to pay out to the bank. They could come and get that from you because there's full recourse.
Correct. Yes. And just to be
Um,
clear, it's only between 80 and above, right? So below that, it's just a standard. There's no protection at all. It's only between 80 and the price you paid, right? So that's the bit that's at risk from the lender's mortgage insurer.
okay, so if you borrowed 95%,
Yeah.
um, and then say that
15, if 95%, 15% will be covered by the lender's mortgage insurance premium. If in fact, when you sold the
okay,
property, you ended up with less than that, then that amount would be paid out. The 15% would be paid out by the insurer to the lender, but then they might come back after you to try and get the difference.
so the bank might come back after you and the mortgage insurer.
Correct.
Oh gosh. Okay. Um, it gets worse.
It does
Um,
get worse.
but if you're going into one of these, you do have the potential option to negotiate refundability if you do decide to leave the property. So that
So,
20 to
so
$50,000 you might have had to spend on that, you could see some of that back if you can get that
yeah.
clause in there.
So you need to ask the question on the way in. It's worth asking whether it's ever refundable under what circumstances. That's a really, really good question to ask.
Okay.
They don't like answering that question, but it's worth asking. And then secondly, in some cases, you can, depends how long the premiums have been running for and those sorts of things. But if it's a relatively short time and you make a lot of fuss, you may be able to get some of the premium back.
Okay. And then the two last points I think I have at the top of my head is that there are ways to get around lender's mortgage insurance if you don't have that 20% deposit. For example, you've mentioned government loan schemes where you'd have to repay it back eventually, or potentially parents or a friend or family member might be able to, is it co-guarantee or put up some
Not
assets to
they
help
they could
cover it?
they could actually just give you cash, or they could be a guarantor. It depends on the particular circumstances. And just with the government scheme, what they do is they guarantee the 80 to 95, right? So it's a replacement for lender's mortgage insurance, right?
Okay.
You still get the full amount from the bank, but the bank again is protected from 80 to 95 in the case of a
Okay.
95% mortgage. So that's the way
Okay.
that works.
Alrighty. So you think, have I missed any major points there?
I do want to make one other point. Of course, the other
Yes,
way
please.
to avoid all of this is to save more, right?
Okay.
So come
Or
in,
spend less,
or
or
well,
both.
spend less, save more. In other words, don't get such a big mortgage, get a smaller mortgage, or save before you actually go into the market. Because if you actually can come in below that 80%, one, you get a cheaper rate, and two, you don't have all these overheads and all these extra fees and costs that we're talking about. So it can be quite advantageous. A lot of people don't do the math, right? And what I find quite often when I speak to people is they spend a lot of time trying to stretch their budget to the max to be able to get that perfect property. Sometimes it's better to compromise, just come down the market a little bit and recognize that you on your first purchase, it won't be perfect, right? You're going to have to make some compromise anyway. But if you can make a compromise such that your financial position is much more secure, particularly in the current environment when incomes are not growing and costs are rising and interest rates may well rise ahead, then it may well be much more sensible to be a little bit more conservative than the banks would encourage you to borrow to, or indeed mortgage brokers who always, of course, want to give you the biggest loan possible.
Absolutely. And actually, to add to that, one of the things we spoke about last time with Steve was, you want to be really conscious of what that's going to leave you with, because the
Yep.
banks they're willing to lend you a lot, and that can end up with a significant impact on your lifestyle. So you really want to think about what this means for 30 years or
Mm.
however long it's going to be.
Well, there's 2 points there. People assume that if the bank says you can have the loan, they assume that they've done all the calculations for you and it's perfectly affordable. That's not true. All they're doing is assessing it from a risk perspective, from their perspective, right? Now, they have an obligation at the moment under the ASIC rules to make sure that the loan is, quote, not unsuitable, but it's very vague as to what that actually means. So just because the bank says you can, borrow 500,000 or $1 million doesn't necessarily mean it's sensible for you. What you need to do is to develop your own cash flows. And in fact, ASIC's Money Smart website has some very good calculators there. Work out what it looks like, and then run some counterfactuals. What happens if interest rates go up 2%? Or what happens if, your job changes and you don't get the income that you currently get? Or, all those things, right? It's worth just running through those rather than just swallowing the story that, yeah, sure, it's affordable, not a problem. You're paying this in rent at the moment. Well, you're not going to be paying any more, which is quite often the story that mortgage brokers use. Just remember that once you've got the property, you've got rents, you've got rates, power, maintenance, ongoing costs, right? A property is not a cheap thing to maintain, right? As well as the mortgage. And remember this, that there is a risk with rates being so low at the moment that mortgage rates could rise later. So you need to be thinking over the 20 to 30-year horizon. The average mortgage rate over the long term in Australia is about 7%, not the 2.5% or even 2% that it is today. And that's worth bearing in mind too.
Absolutely. Thank you. Alrighty. So, do we want to talk about if you're already in this situation? What are some of the things that you can maybe do to
Right.
protect yourself going
So,
forward?
so the first point is that if you start paying down the mortgage and essentially you get below that loan to value ratio, you don't get the premium back. Right? That's a myth that's around out there. It doesn't work
Okay.
like that. So
Uh-huh.
once you've taken the premium is paid. Right? The only situation that I've seen where you can actually negotiate to get some of it back is if you then subsequently move and move to another property, or indeed go to another lender and borrow less. Right now, in those situations, you have to be very proactive about it and ask the bank, who will probably not want to have the conversation but persist, and you might be able to get some of it. I've heard of some people who've got, for example, half the premium back, having moved 18 months later. So it's worth shopping around. But like I said, once you've committed to it, you are committed to it. You don't suddenly get it back when you reduce the value of your mortgage.
All right. Um, Actually, there's one more point I wanted to jump into, if you don't mind, Martin.
Hmm.
So you touched on this idea that typically there's the two main external lended mortgage insurers, but that the banks have actually started going into this space and providing the insurance themselves. So I guess in my mind, that makes me a little bit concerned because it is double incentivizing the bank to push you into something higher. And so obviously we've discussed the regulatory side of that, but
Hmm.
am I thinking about that the right way, or
You
are there
are.
other concerns?
No, absolutely. So the first point is it allows the banks to lend more at a higher loan to value ratio. And as like I said, APRA has given them capital relief, so they're quite keen to do it. And sometimes, perhaps their due diligence processes will be less robust because they know that they've got this extra protection. The other point, though, it's generating additional income for them, isn't it? Because they're going to charge you an extra fee, 20, 30,000, whatever it is, right? And or they might even put the interest rate up on your mortgage as a result of it. So both those actually generate more revenue to the bank. So my view is that the reason they've done this is because they can actually generate more revenue. They don't have to effectively pay as much to the mortgage insurer, and all of those things mean that the formulation for the bank is actually in their favor. Remember, folks, if you're talking to your bank, the bank is interested in their bottom line, not yours.
Absolutely. Um, and so when you're talking to a bank and they're saying you'll need LMI, can you ask them who's going to provide it, and do you have a choice in that?
You almost don't have a choice. They normally
Okay.
have a particular contract with one of the lenders mortgage insurers. The only question is whether, in fact, it's an internal or an external one. And there is a little bit of fluffiness sometimes with some lenders as to whether they'll do it internally or whether they'll do it externally. So
Okay.
it is worth asking the question: who is the lender's mortgage insurer provider? What is the premium? What are the terms under which the premium is actually calculated? And under what circumstances could the premium be refunded? Those are the questions that I would ask, assuming that you're in the situation where you're going to need to grab lender's mortgage insurance.
Okay. I think that's a great place to end, Martin, with those few questions for people to be aware of when they're heading into this situation. So, thank you so much for your time today and sharing your knowledge and research in this area. Do you want to maybe tell listeners where they can get in touch with you and hear more from you?
Sure, absolutely. Well, I thank you for your time today. And this is really important, and I'm quite passionate about this because I think people are being taken to the cleaners. So anything we can do to help is great. And if you want to find out more, my YouTube channel is called Walk the World, and we have daily shows there about finance, economics, and property. And I also have a blog at digitalfinanceanalytics.com.au. And if you want to ask me a specific question, you can go to the blog, and I'll send me a question, and I'll try and help.
Excellent. And so then before I say goodbye to listeners for today, if you have any feedback for me about this episode or any ideas for future topics, please let me know either in the YouTube's comment section or send me an email at contact@nucleuswealth.com. And did you know that Nucleus Wealth actually offers personalized investment portfolios and that we offer limited investment advice around that? You can find out more about that at nucleuswealth.com, or you can give us a call on 1300 623 863. Thanks to my producer Jaden Stent for his work today and all our other episodes. And thanks again from myself and the team. And we look forward to catch you on the next one.